Picture this. You're standing on the banks of the Rhine River in Cologne, Germany. For nearly a century, since 1931, the Ford Motor Company plant here has been the beating heart of the city. It was more than a factory, it was a monument to American economic dominance. It was proof that American capital, American innovation, and American jobs could conquer the world. But today, January 12, 2026, that heart is barely beating. Ford has just slashed another 1,000 jobs. The assembly lines that once churned out the vehicles defining Europe's middle class are grinding to a halt, reduced to a single, lonely shift. It is a slow, painful death. Now, cut to a 4-hour drive east. Arnstadt. A former East German border town that, for decades, was an economic ghost town. Today? It is booming. But it's not American money fueling this fire. It's not German money either. It's the contemporary Amperex technology company, better known as CATL. A $2 billion megafactory employing 2,000 people, churning out the batteries that will power the next generation of European vehicles. This isn't just a story about cars. This is the single most important economic shift of our lifetimes. The flow of global capital has reversed. For 70 years, money flowed from New York to the world. Now, the US is pulling up the drawbridge, locking itself in a fortress of tariffs and military intervention, while China is doing exactly what America used to do, buying the world, one factory at a time. If you think this is just a geopolitical game, check your portfolio. Check your 401k. Because the companies you own in the S&P 500 are being encircled. The US dollar's dominance is being tested like never before. And the global supply chain that keeps your inflation low? It's being rewritten. Welcome to the great capital reversal. Let's peel back the layers. Let's look at the big picture. It's 2026. President Donald Trump has been back in the White House for a year, and he is not playing games. We've seen tariffs slapped on everything that moves. We've seen supply chains shattered. And just this month, we're seeing American military intervention in Venezuela to secure oil reserves. The message from Washington is clear: America first, and America alone. The strategy is home shoring. The White House wants to force companies to bring production back to US soil. And on paper? It sounds great. Trump is boasting about $21 trillion in investment pledges. But let's be real, Wall Street knows the difference between a pledge and a wire transfer. Bloomberg Economics suggests the real number is barely a third of that. While the US is retreating into this protectionist shell, trying to create a manufacturing renaissance that is moving painfully slow, a vacuum has opened up on the global stage. And nature abhors a vacuum. Enter China Inc. 10 years ago, when Chinese money went overseas, what did they buy? They bought trophies. They bought the Waldorf Astoria in New York. They bought soccer teams. They bought movie studios. It was flashy, it was expensive, and frankly, it was often stupid money. That era is over. The spending spree happening right now in 2025 and 2026 is lethal, strategic, and disciplined. They aren't buying hotels, they are building greenfield projects. For those of you not deep in financial jargon, greenfield investment means building something from scratch. New factories. New data centers. New infrastructure. This is the holy grail of economic development because it creates permanent jobs and deep political influence. In the first half of 2025, outbound investment from China overtook the United States. Let that sink in. China is now the primary source of new industrial capital for the world. They are capturing 10% of the global total, while the EU has seen inbound investment collapse by 45%. Why does this matter to you sitting in Chicago or Toronto? Because money buys leverage. When China builds a $6 billion battery plant in Indonesia or a $38 billion data center in Brazil, they aren't just conducting business. They are embedding themselves into the operating system of those nations. They are becoming the essential partner. The US is betting on isolation and brute force. China is betting on ubiquity. And if history has taught us anything from the British Empire to the post-World War II American boom, it's that the country who writes the checks, writes the rules. You might be asking, wait, isn't China's economy in trouble? The property crisis? The deflation? Yes. And that is exactly why this is happening. This is what economists call a capital spillover, but I call it the desperation export. Here is the mechanism you need to understand to protect your wealth. For decades, China ran a massive trade surplus. They sold us cheap plastic goods and electronics, we paid them dollars. What did they do with those dollars? They turned around and bought US Treasury bonds. They funded our government debt. It was a cycle: we buy their stuff, they buy our debt, interest rates stay low, Americans keep buying houses. That cycle is broken. As domestic consumption in China falters and their property market remains a smoking crater, Chinese companies can't make high margins at home. The competition is too fierce. So, the state is directing that massive pile of trade surplus cash away from US treasuries and into foreign factories. Brad Setzer, a sharp guy from the Council on Foreign Relations, pointed this out. The Chinese state banks are no longer just recycling dollars into American debt, they are funding the outward expansion of Chinese corporations. The financial impact on you: if China stops buying U.S. treasuries to fund factories in Brazil and Hungary instead, who buys our debt? The U.S. government is running massive deficits. If the biggest buyer walks away, yields go up. When yields go up, your mortgage rate goes up. Your credit card APR goes up. The cost of capital for every American company skyrockets. This is the hidden tax of the Great Capital Reversal. And the Chinese government is doubling down. In late 2024, the Communist Party published a directive to strengthen the framework for outbound investment. Premier Li Chang is practically pushing CEOs onto planes. They are offering cheap state loans to any Chinese company brave enough to build a factory in Mexico, Vietnam, or Europe. This is a coordinated national strategy to export their excess capacity. They have too many solar panels, too many batteries, and too many EV platforms. They are flooding the world with them, not just as exports in shipping containers, but by building the factories in your backyard. Let's talk about the neighbors. Let's talk about Mexico. For the last few years, the buzzword on Wall Street was friendshoring. The idea was that if we can't make it in America, we'll make it in friendly countries like Mexico, away from China. Well, guess who followed us there? President Claudia Sheinbaum in Mexico is stuck between a rock and a hard place. The Mexican economy is contracting. They need investment desperately. But the US is hesitant, paralyzed by political uncertainty and companies waiting to see what Trump does next with the USMCA trade deal. China isn't waiting. Chinese companies are setting up shop in Mexican industrial parks at a record pace. Why? Because if a car is made in Mexico, it might bypass US tariffs. It's a backdoor. A Trojan horse. Trump knows this. He's threatening to blow up the trade agreements. Mexico has tried to appease him by slapping 50% tariffs on Asian imports, but the factories are already being built. This puts the US in a dangerous position. If we squeeze Mexico too hard to kick China out, we crash the Mexican economy, leading to more migration crises at the border. If we let it happen, Chinese companies capture the North American supply chain. And it's not just Mexico. Look at Southeast Asia. Singapore's Prime Minister Lawrence Wong recently gave an interview that should terrify American diplomats. He basically said, "Look, we love America, but you guys are losing the plot." US investment in Thailand and Indonesia is slumping. American executives are terrified of the geopolitical risk. Meanwhile, ByteDance is building data centers in Thailand. CATL is breaking ground on a $6 billion plant in Indonesia. Dan Wang from the Eurasia Group nailed it: US companies are retreating because they can't compete on cost. Chinese companies are expanding because they can't make money at home. The result? The swing states of the global economy, Indonesia, Brazil, Thailand, Saudi Arabia, are economically integrating with China, regardless of what security treaties they have with the US. Now, back to Europe. This is where the rubber meets the road, literally. The European auto industry is the pride of the continent. Volkswagen, BMW, Mercedes. They are the gold standard. Or they were. The collapse of the Ford plant in Cologne is just the tip of the iceberg. The European Union is in a panic. They've slapped tariffs on Chinese EVs, but it doesn't matter if the Chinese build the cars inside Europe. BYD is building in Hungary. CATL is in Germany. And now, Volvo. Volvo is the fascinating case study here. Geely, the Chinese giant, bought Volvo back in 2010. Everyone thought they would loot the technology and kill the Swedish brand. Instead, they revitalized it. Volvo is profitable, it's growing, and it's hiring in Gothenburg. But here is the twist. Europe is now begging for this money. French President Emmanuel Macron, who talks a big game about European sovereignty, was in Beijing in December effectively pleading with Xi Jinping to send more money. Rebalance the relationship, he called it. Translation: please build factories here because our own companies are failing. This is a humiliation for the West. We are seeing a role reversal that was unimaginable 20 years ago. The US and Europe are becoming the consumers and the landlords, while China becomes the industrialist. And the American response? The big three automakers are waving the white flag. Ford isn't trying to fight BYD alone anymore. They announced a partnership with Renault. Why? To share costs because they are, in the words of CEO Jim Farley, in a fight for our lives. Even worse, Ford and Stellantis are partnering with CATL in the US and Europe. They are using Chinese technology to stay alive. They are becoming assembly plants for Chinese intellectual property. If you own Ford or GM, you need to ask yourself, do these companies have a future as innovators, or are they destined to become just brand stickers on a Chinese-engineered skateboard? The market is already voting. Just look at the PE ratios of legacy auto versus the tech-heavy Chinese entrants. We cannot ignore the elephant in the room: energy and resources. Trump's intervention in Venezuela is a desperate attempt to secure oil. It's a throwback to 20th century geopolitics. But the 21st century economy doesn't just run on oil. It runs on copper, lithium, cobalt, and nickel. While the US Marines might be securing oil rigs in Maracaibo, Chinese state-owned enterprises are locking down the copper mines in the Democratic Republic of Congo and the nickel refineries in Indonesia. In Nigeria, a Chinese consortium is building a $20 billion gas city, $20 billion. That is an infrastructure project on a scale the West simply does not do anymore. They are playing the long game. The US is focused on extraction, get the oil, get out. China is focused on processing and integration. They are building the refineries, the ports, and the roads. This means that even if the US reshores manufacturing, we might still be buying the raw materials from Chinese-owned mines in Africa or refineries in Indonesia. This is a chokehold. If you are an investor, this signals a massive bull run for commodities, but a volatile one. The West will eventually wake up and try to secure these resources, but China has a 15-year head start. So, where does this end? Let's game out the scenarios for the next 5 years. Scenario 1, the fortress hold trumps tariffs and aggressive home shoring policies work. The pain is high for a few years, inflation spikes, goods get expensive, but eventually, foreign capital is forced to build inside the US wall to access the American consumer. We see a reindustrialization of the Rust Belt, funded by foreign money. The US becomes a high-cost, high-wage island. Investment play, small-cap US manufacturing stocks, automation companies, and US energy. Scenario 2, the dollar dilution. The world calls America's bluff. China continues to successfully pivot to the global south. They build a parallel economic system that doesn't need the US dollar. The demand for US treasuries collapses. Interest rates in the US stay permanently high. The US suffers from stagflation, low growth, high prices. Investment play, gold, Bitcoin, emerging market ETFs, and commodities. My prediction, we are heading for a hybrid. The US will remain the most powerful individual market, but we are losing the network effect. The Western alliance of commerce is fracturing. We are seeing a world where capital has no flag. Ford is using Chinese batteries. Europe is begging for Chinese factories. The US is fighting for Venezuelan oil. The wallet connection, final warning. What should you do? 1. Watch the debt market, keep your eyes glued to the 10-year treasury yield. If foreign investment stops buying our debt because they are using that money to build factories elsewhere, rates will spike. That crushes tech stocks and real estate. 2. Diversify out of the dollar. I'm not saying sell everything, but the era of the US dollar having zero competition is ending. Having exposure to real assets, land, commodities, precious metals is insurance against the de-dollarization of global trade. 3. Be careful with legacy industrials. Companies like Ford, Volkswagen, and even Boeing are in the fight of their lives. They are burdened by old supply chains and old thinking. The winners will be the companies that control the new supply chains, whether they are American, Chinese, or something in between. The Ford plant in Cologne is dying. The CATL plant in Arnstadt is thriving. That is the trend. Do not bet against the trend. The world is changing fast, and money is moving even faster. The US is rewriting its economic compact with the world, transitioning from a benevolent global banker to a jealous guardian. It's a dangerous time, but for the observant investor, it's the opportunity of a lifetime. Thanks for watching. If you want to know which 3 specific sectors I'm buying to hedge against this shift, check the link in the description. And as always, watch your portfolio, because Wall Street won't watch it for you. See you in the next one.